All right, all right. Happy recession day, everybody. Or happy not recession day, I guess we should say. Happy transitory recession. I heard Dan over at I allegedly had called it a repression, not a recession, a repression. Interesting spin on words. Whatever you call it, today we get GDP or gross domestic product, the sum of all goods and services produced within the United States economy for the second quarter of 2022. And that number comes out in about another 14 minutes. Right now, we are looking at the Atlanta Fed's GDPNow, which is their tool that estimates gross domestic product based on economic data as it comes in throughout the quarter. That is sitting at an expectation for a negative 1.2% read for the GDP for the second quarter, which, if you take that on top of the negative 1.6% read we got in the first quarter, that would meet the textbook definition of a recession, although there is a lot of political nonsense going on right now, kind of retroactively declaring, no, that's not really a recession. We have to have these suits at this bureau over here. They have to declare it a recession. And as long as we promise them a job or something or generous speaking fees, maybe they'll never declare it a recession. And therefore, everything is just fine, right? Kind of like the captain of the Titanic standing on the deck saying, it's okay, folks. I have declared this ship to be a submarine, so nobody's going to drown. Probably doesn't really work that way. Anyways, we get that today, and I figured we would take a quick look. I am going to share my screen here with you guys, and we are going to bring in Mish the Mod. What's happening, Mish? How we doing today?
I'm doing great. How you doing, man?
I'm doing good. It's been a nutty week. We had a lot of big earnings this week. Got even more big earnings coming out today. We had that whole big spiel from the Fed yesterday. I'm still grinding my teeth over some of the things I heard Jerome Powell say at the Federal Reserve yesterday.
My jaw hurts.
Yeah, yep. And then we get this one. This is not, I guess what we won't say, this isn't like the finale to this week. This is a big one. This is the big data point I've been waiting for. But we've still got Apple and Amazon earnings after the closing bell today. That's like $3.5 trillion worth of market cap in just those two names reporting their earnings today.
Yeah, that's a lot of money coming in. Yeah.
So what I'm looking at here on screen, this is BEA.gov, or the Bureau of Economic Analysis over at the U.S. Department of Commerce. That's who actually releases the GDP. And we will see, I'll be refreshing the screen as 8:30 approaches. I'll be refreshing the screen like a madman, trying to catch this data the second it hits. Right now, it's still reporting the last report from Puerto Rico on July 26th. And right down here, you can see the Q1 report, which I have queued up right now. We can take a look at what the Q1 report looked like. Now, what's coming out today for Q2 is the first estimate. That's important because there are two additional estimates that come in subsequent months where the number gets a little bit revised and tweaked, but usually the first estimate is pretty close. The initial estimate for Q1 came in at negative 1.4, then it ticked down to 1.5, then negative 1.6. So here's what we're looking at. This chart is going back to all the prior quarters, all the way right up until 2018. You can see here these two big downward bars right here. That was the pandemic recession. We had one really big downward tick, but that was actually the shortest recession in the history of the country. It was only 2 quarters, which nobody argued about the definition of a recession back then. I guess when somebody else is in charge, the definition is a little more loose than it is now. But of course, then came the trillions and trillions of dollars of money printing, which brought the GDP right back up. And then lo and behold, last fall, when we started the taper, I don't know if you guys remember the taper, talking about slowing down the rate of money printing at the Federal Reserve. As soon as we start slowing down money printing, wham, first quarter GDP goes negative. It's almost like our whole economy was hopelessly dependent on cheap interest, cheap debt, and easy money.
I think a lot of people actually forget how dismal December really was. That month was horrendous.
Absolutely was. And, markets just started taking a dive. It was really about January 5th that markets just started going down and they never looked back. Interest rates just straight up pretty much for the first 5.5, 6 months of the year, straight up. So, I mean, it's been a really tough start of the year. Why? Because the Federal Reserve took away the punch bowl, right? The party's over as soon as the punch bowl gets taken away. I don't know what the Fed put in
Yeah.
the punch. Don't ask questions like that. Real quick, I have to send a shout out. I don't have the comments up here. I am slow, but hey, thank you very much, Jose Orozco, for the super sticker. I appreciate that, buddy. Appreciate the support of the channel. Had the chance to meet Jose in San Antonio. It was a good time. He bought me the Bucky's corn nuggets. I'll never forget Jose with the Bucky's corn nuggets. Those things were good, man. It's a good thing I don't live in Texas. I'd add back on those things. All right, but going back towards the to the first quarter report here, I'm going to read a little bit off of this. Real GDP in the first quarter decreased at an annualized rate of 1.6% in the first quarter, according to the third estimate released by the BEA. In the fourth quarter of 2021, real GDP had increased by 6.9%. The third estimate of GDP released today, this is a couple of weeks old, is based on more complete source data than were available for the second estimate that was issued. In the second estimate, the decrease in real GDP was 1.5%. The update primarily reflected downward revision to personal consumption expenditures, which is the Fed's preferred method of inflation, and that was partially offset by an upward revision in the private inventory investments. And private inventory investment, that is counted as business investment. So when you see big inventory growth, that tends to skew GDP upward. And I would also like to add that they call this real GDP. This is adjusted for inflation, although it's adjusted using government figures. So the government figures, we all know they dramatically understate what actual inflation is. So allegedly, these numbers are adjusted for inflation, but not really. If we got negative 1% GDP last quarter using the government's GDP adjuster and the BEA, they don't use CPI. They use a different method to calculate how bad inflation is. But suffice it to say, it's well below the actual 17, 18% inflation if you go by shadowstats.com, which is a more consistent method. So these are adjusted for inflation numbers. And I have to say thank you very much to Mr. Mike Bender from Robin RC Models for your super chat, sir. Thank you very much. He says, "Good morning. Let's hope they at least honor the mental illness and we get some solid green candles on a bad GDP figure. God forbid Apple is a surprise new all-time high." Thank you very much, Mike. I appreciate the support of the channel. And what he's talking about with honor the mental illness, that is the recent trend where it doesn't matter how bad the news is that comes in, this market wants to go higher. And we've had some really terrible, terrible earnings this second quarter, starting all the way back a few weeks ago with the bank earnings. They were abysmal, down 20, 30, 40, Goldman Sachs 48% year over year, and yet the stocks rallied. This week, most of the earnings have been bad. Google was bad, but I guess they were expecting worse, so the stock rallied. So that trend appears to be continuing. And then yesterday, when the Fed signaled that there may be a reduction in the pace of quantitative tightening ahead, well, the market took that and they just ran straight up with that news because the market was looking for some early signs of the Powell pivot, and we finally got that yesterday when Powell suggested that reduced rate hikes may be appropriate come September, and there is no Fed meeting in August. So stocks really like that. Thanks again, Mike. I really appreciate the support of the channel, sir. And yeah, if we get some good surprise to the upside from Apple today, markets will obviously run with that. And don't overlook Amazon either. We have a lot of information coming out from Amazon. We are now 6 minutes away from the GDP estimate coming out. Real quick, let's take a look through the indices. And I don't have my charts quite where they need to be right now. I'm a little off my game. It is the morning, folks, but the Dow is looking like it's set to open down 62 points or negative zero point 0.2. The S&P is going to or set to open down 13 points, negative 0.34%, down about a third of a percent. And the NASDAQ is set to open down almost 100 points or negative 0.76%. Now, it's something I mentioned on my Patreon Zoom call yesterday. Whenever you get a big data point release like this, like the Fed decision yesterday, or like a CPI release, or any big data point, the algorithms right now are programmed to immediately skim that report, find a certain number or a certain phrase, and if a certain threshold is met, go buy everything or go sell everything. Right. So the initial reaction to a report is not always the correct one. Sometimes, like a couple of months ago, you can get 1,000-point rally, and then the next day, the programmers go in, they change the parameters in the algorithm, and you get 1,000-point sell off as soon as it came in. So I usually say on my live streams, not financial advice, not financial advisor, all that CYMA stuff, but I usually say don't try to get caught up in the algorithms in the first few minutes of trading. You do not have the reaction time or the firepower to compete with a software program that's moving around billions of dollars. So I don't even try. That's my personal approach. I set my trades in advance and then I sit back and I watch, although I have no trades set right now because I have been just beside myself watching all this news come in bad and watching markets go up. This is an irrational market. I'm not getting mixed up in it. I have been watching a technical level on the NASDAQ. If we go above 12,300, this is looking at the futures, not the actual index right now, by the way. But if we go above 12,300, that is a signal confirming a big breakout from a descending wedge pattern, which would mean the indexes are all going higher. We're getting close to that level now. We're not quite there yet, but we are getting close. And I also have to send another shout out. Thank you, Mr. Steve Woitas, for the super chat, sir. I appreciate that very much. And Steve says GDP also includes government spending. That's a very good point, Steve. So is it an accurate measure of private sector fiscal health? Well, it's not a pure measure of private sector fiscal health, and because it does include the government spending. But I would add that government spending in the second quarter of this year really wasn't that bad. I have to say, because we've got gridlock in Congress, nothing is getting done. So government spending probably won't be a huge boost to GDP, with the one asterisk that defense spending. Countries all over the world are arming up right now. They're buying a lot of fighter jets, they're buying a lot of missiles, right? And most of those are made by US companies. So those are exports. So the marching off to war, that will actually skew GDP to the upside. Unfortunately, that's such as the state of geopolitical affairs that we live in. But thank you, Steve, very much. And that is a good point about government spending being included in that number. This is not just the private sector. We are now 2 minutes.
On top of that,
go ahead.
I was going to say, on top of that, we have jobless claims coming out at exactly the same time as GDP.
Oh, I didn't even realize that. Is that initial and continuing is coming out?
Yes, sir.
All right. So, we've been talking a lot about jobs here on this channel. We have seen the uptick in initial claims has already started. We're starting to see the very early signs of uptick in continuing claims, but that unemployment rate still flat at 3.8%. And that's kind of like the missing ingredient to the housing crisis that a lot of people are calling for, and the recession. Whether or not the reason they're saying it's not a recession is because unemployment is so low. Well, we'll see if that low unemployment holds, because I'm seeing a lot of headlines about hiring freezes, about layoffs, about job cuts. They're starting to pile up, and eventually that will take its toll in the economy. That'll take its toll in the housing market and just about everything else. All right, we got 1 minute remaining until the report comes in. I'm going to start refreshing the BEA website here because I want to catch it as soon as it hits the tape. What do you think it's going to come in at, by the way? I'm going to say negative 2%. That's my estimate. And that's based on, Atlanta Fed's GDPNow has historically been very accurate, but not since the pandemic hit. It's actually been off to the upside. The Atlanta Fed's GDPNow was predicting a positive number last quarter when we got that negative 1.4% surprise that was revised twice down to negative 1.6. What do you think?
All right, I have the cursors coming. I really think we're going to be at negative 1.0.
A cool 1%. By the way, we
jobless claims are up.
All right, why don't you take us through the jobless claims, Mish, while I am looking up. Here it is. GDP just came out. Hold that thought. All right, Mish, looks like you're the winner. Gross domestic product for the second quarter of 2022, the advanced estimates, real GDP decreased at an annual rate of 0.9%. Mish, you said 1%. You were way off. way off
I know,
in the
it's
second
horrible.
quarter of 2022. According to the advanced estimate released by the Bureau of Economic Analysis, in the first quarter, real GDP decreased 1.6%. So there you go, folks. The technical definition of a recession. I don't care what the talking heads in politics say. 2 consecutive quarters of negative economic growth. That's the R word, folks. That is a recession. We're now in one. Or as Captain Barbosa would say, you best start believing in recessions. You're in one. GDP estimate
Well,
released
price
today.
index went way up. GDP
So
price index went up
where
was up 0.6%, and it's above more than 1 point than what they thought it would be. I was going to talk a little bit while you're
yep.
pulling up the report. The initial job claims they revised last week up, and then this week came in at 256, was a little above what they expected. The 4-week average is at 249. They expected it to be at 243, so that is up. Continuing jobless claims did go down by 30,000. I'll have to go into the household and see if they agree with that with the household numbers. And then PCE actually came out too as steady as last month. They were expecting it to go down. Core did go down to expected, and consumer spending went up by 1%, but it was 1.8 last, so it is going down.
And consumer spending is a nominal number. That I don't believe that one's inflation adjusted. But back on the GDP number here, the decrease in real GDP reflected decreases in private inventory investment, residential fixed investment, i.e., homes, federal government spending, state and local government spending, and non residential fixed investment, that's commercial real estate, that were partially offset by increases in exports. There's your weapons and there's your strong dollar, and personal consumption expenditures. There is the inflation number. Imports, which are a subtraction in the calculation of GDP, also increased. There's also your strong dollar, showing the dollar goes further, we buy more stuff. The decrease in private inventory investment was led by a decrease in retail trade, mainly general merchandise stores, as well as motor vehicle dealers. Makes sense. The car lots still have very, very low inventory. The decrease in residential fixed investment was led by a decrease in other structures, specifically brokers' commissions. The decrease in federal government spending reflected a decrease in non-defense spending that was partially offset by an increase in defense spending. There's everybody being marched off to war. And the decrease in non-defense spending reflected the sale of crude oil from the Strategic Petroleum Reserve, which results in a corresponding decrease in consumption expenditures. That's interesting. I was wondering if the SPR release would have an impact on GDP. It looks like it was a negative impact on GDP. That's interesting because the oil sold by the government enters private inventories. There is no direct net effect on GDP. The decrease in state and local government spending was led by a decrease in investment in structures. Decrease in non-residential fixed investment reflected a decrease in structures and equipment that were mostly offset by an increase in intellectual property products. The increase in imports reflected an increase in services led by travel. I guess travel counts as an import. We saw that travel in reflected in Visa's earnings in the last quarter. Americans taking their strong dollars overseas where they go further and traveling more. Also, Americans sick of being cooped up after 2 years of ridiculous lockdowns. Not going to get myself in trouble. Moving on. The increase in exports reflected increases in both goods, led by industrial supplies and materials, and services, led by travel. The increase in PCE reflected an increase in services, led by food services and accommodations, as well as healthcare. That was partially offset by a decrease in goods, led by food and beverages. Real GDP decreased less in the second quarter than the first quarter, decreasing 0.9% after decreasing 1.6%. I would also add that first quarter GDP had that Omicron variant factor in there. If you remember, everybody got sick in January. Everybody. That had a negative effect on GDP. The smaller decrease reflected an upturn in exports and a smaller decrease in federal government spending that were partially offset by larger declines in private inventory investment and state and local government spending, a slowdown in PCE, and downturns in non-residential fixed investment. That's a mouthful there. And residential fixed investment imports decelerated. Current dollar GDP, i.e., nominally not adjusted for inflation, increased 7.8% at an annual rate, or $465.1 billion in the second quarter, to a level of $24.85 trillion. In the first quarter, GDP increased 6.6%, or $383.9 billion. Now remember, that's current dollar GDP. That's when they take out the inflation adjuster. The price index for gross domestic purchases increased 8.2% in the second quarter. That's their inflation adjuster, the price index for gross domestic purchases, compared with an increase of 8% in the first quarter. So inflation got a little worse, but notice 8.2%. That's even lower than the CPI, which we all know is even lower than the actual rate of inflation. So if they were to actually adjust GDP for the actual rate of inflation, we would be double digit negative, or at least close to double digit negative. Let's see. On personal income, they're saying current dollar and non-inflation adjusted income increased 353.8 billion in the second quarter, compared with 247.2 billion in the first. The increase primarily reflected increases in compensation led by private wages and salaries, proprietors' income, both non-farm and farm, and personal income receipts on assets and rental income. What else we had? Disposable income increased 294.1 billion, or 6.6%. I disagree with the sentiment there in the second quarter, in contrast to a decrease of 58.8 billion, or 1.3% in the first quarter. Real disposable income, as in adjusted for inflation, decreased 0.5%, compared with a decrease of 7.8%. And again, that's real adjusted using that 8% inflation adjuster. You actually use the real number, real disposable income is down significantly. And that makes sense when you look at, say, that warning from Walmart that said they're not selling any clothes, they're not selling any general merchandise because people are spending all their money on food. There is less disposable income left. Personal savings rate, personal savings as a percentage of disposable personal income, was 5.2% in the second quarter, compared with 5.6% in the first quarter. So there you have it. It's a pretty bad GDP report. I would say not as bad as I was expecting. What do you think, Mish? I mean, you were kind of right on the money there.
I think it was right, kind of in line where I thought the people's accounts going down and a lot of the other categories are about what I thought they were going to be. I think for the third quarter, it's going to be much rosier because we are going to start spending money again here real fast with the bills that are coming out. So we're going to pump in $500 billion here in the next 6 months. They're going to try and bring that back out. But I think with today's report, it shows what we've been talking about this entire time, that it's not as rosy as everyone thinks it is. And I think with that and the job numbers still coming up, it's a pretty good indication that we are not at a bottom. Unfortunately, well the stock market took it like a champ.
Yeah, I'm looking at the indexes right now. I see no movement in stocks on this report. So if you were expecting GDP to move the needle, got another thing coming. Looks like the market's just gonna take this one. Now, again, I would say this is bad news, a negative GDP read, although negative 0.9 could have been a lot worse, right? Considering the way things really missed.
It was a miss by 1.4%, which is a huge miss.
So you're referring to the analysts' expectations, right? The analysts were expecting 0.5.
So with that, everyone should be freaking out on the miss, but they're not, because if you look back at the last, I don't know, several months or so, every time there's bad news, as long as there's one kernel of good news in there, they'll take the good news. I didn't see a whole lot of good news. I saw not as bad news, but yeah, I would think the market would take this one a little more serious, but yeah, they're not.
Well, if I had to interpret that, I would say that's because we are looking at a singular trade market. Right now, data doesn't matter. Earnings don't matter. The economy doesn't matter. It's all about the Fed. It's all about the easy money coming back. And that's my guess why the market can take this in stride like that. Why they can just shrug off this bad numbers, because they don't care. The Fed is going to print the money and dump it again. And the Fed, let me clarify, the Fed didn't come out and say we're going to start printing again. They didn't say that yesterday. They said reduced rate hikes may be appropriate in the future. They said they're going to be data dependent. That was the first move in a dovish direction for Jerome Powell in a long time. So the market interpreted that as there's a light at the end of the tunnel. The easy money could be coming back. So
Right. And the spin on this is, we've got the 2 adjustments coming up, so it could become positive. So we're going to get told we're in a technical recession, or we're in a growth recession, or these aren't the real numbers. And then they're going to dump a bunch of money hoping that it's positive in the third quarter and the story goes away.
they're going to hope for that. And, we saw that yesterday. We see the press and even the Federal Reserve amazingly circling the wagons around the White House to come to their rescue and say, no, it's not really a recession. I guarantee if we go to CNBC right now, we will find some paragraph within the first 3 paragraphs of the headline saying it's not a recession. Here we go. GDP. Let's see what CNBC has to say. GDP fell 0.9% in the second quarter, second straight decline, and a strong recession signal. Ooh, that might upset the handlers at the White House. A strong recession signal. The U.S. economy contracted for the second straight quarter from April to June, hitting a widely accepted rule of thumb for a recession, the Bureau of Economic Analysis reported on Thursday. I'm a little surprised there to see them making that admission in the first paragraph. Pressured by surging inflation, rising interest rates, and intensifying supply chain pressures, gross domestic product fell 0.9% for the period, following a 1.6% decline in the first quarter. The Dow Jones estimate was for a gain of 0.3, so it is a miss to your point, Mish. Here we go, though. Officially, the National Bureau of Economic Research declares recessions and expansions and likely won't make an adjustment on the period in question for months, if not longer. So they did put that in the third paragraph. I said within 3 paragraphs, they'll make that excuse. And just made it in there in the third paragraph where they talked about the NBER, which are these economists that they're in charge of declaring a recession. There's 8 or 9. They all just happen to be Ivy League professors, right? So, do you think some hoity-toity economic academics from Ivy League institutions, you think they might have a little bit of a political inclination in one direction or another? I just throw them out there.
Yeah, just a little bit. And seeing how they're all up in the Northeast. So this council everyone talks about is all up in like Harvard area.
2 of them are married, by the way.
Where it's headquartered. Are they?
Did you know? Two of the NBER, I think there's 8 of them. I don't know exactly, but I know 2 of them are married to each other. Like, nice independent bureau you got there.
Yeah.
Anyway. Hey. I got another super chat from Mr. Mike Binder from Robin RC Models. Thank you, Mike. Appreciate that very much. He says, I think any news that don't revolve around suffocating on a ventilator is still good news. Impressive psyop. Eat the bugs. Yes, you will eat the bugs and be happy, Mike. This ridiculous assault on farmers that's going on in the world, the move to force the poor people to eat bugs and tell them it's okay, it's for your own good, and it's for the planet. You first, Klaus Schwab. You first. When I see Klaus Schwab grab a bowl of mealworms and shove those maggots in his mouth and say, the bugs are delicious, then we'll talk. Until then, keep your filthy fingers off my steak. That's just all I have to say. I like my cow. I like my chickens. I'm getting eggs from my birds, by the way. They started laying eggs this week. Getting my first couple of eggs. Thank you, Mike. I really appreciate the super chat and the support of the channel as always, sir. Thank you very much. And we have got 550 people watching right now. Thank you guys for joining us today. I hope you will consider liking this video and subscribe to my channel. This is the first time we've done a live stream for a GDP release because this was kind of a big one. But we usually do CPIs. We did the Fed yesterday. We also do our weekly live streams on Tuesday and Friday. And we do some shorter videos too. So I hope you guys will stick around and, stay with us for a little while. But if you are just joining us right now, the headline number, negative 0.9%. Now, let me put a ticker up here real quick. Mish, why don't you talk a little bit more about the did you get the unemployment numbers that just came in?
I did. Yep, I'm ready when you are.
What we got there?
Okay, so going back over the unemployment numbers, the jobless claims, they adjusted last week's, first of all, up to 261. So that was a slight thing they love to do now. is adjust last week's without really being above board. It was 251. They adjusted to 261. So now jobless claims are at 256, which looks like it went lower, but it didn't. So right now we have 256. The jobless 4-week average went up by 6,000 last week. So we're still coming up, and the average is below the initial claims that will continue to come up.
All right, let me bring
Continuing
this
to
one up.
come down a little.
So here's the initial claims chart that we're showing. Now, I believe I can set this to a line chart so you can kind of see that. And if we do like a 1-year trend, okay, that kind of tells a different story.
That's much
There,
better.
there's your initial jobless claims. Clearly, we bottomed in April, and we've been ticking up since. So they came down a little bit. There's that little downtick, um, but obviously, we still have an intact uptrend in our initial jobless claims.
Right. And the continuing claims average over the last 4 weeks is still up significantly by like 50, 60,000 from a month ago. That's just the average.
All right,
And
let's
we
bring
also
up
had PCE came in.
I'm looking at the continuing claims now.
Mm-hmm.
Let's look at the same 1-year chart. All right, so continuing claims, again, this chart will lag the initial claims, so not as clear of an uptrend. Again, it does look like we reached a bottom, but our bottom for continuing claims came in around June. Again, it lags the initial claims, which bottomed in April, and you still have that choppiness there. But it does look like we're kind of turning upward, still not a big trend. So we're not looking at a huge spike in unemployment anytime soon, I think is what we can draw from this data.
Yeah, while I'm going to look up household numbers real quick because that to me is a better indication.
Yep.
And
Folks,
I'm gonna have
if
to
you are
search it.
just joining us, GDP came in at negative 0.9%. Government spending was down. State and local spending was down. Just about every category was down. Analysts were expecting, I've seen expectations anywhere from plus zero point 0.3 to plus zero point 0.5. So it's a pretty significant miss. I would also add that the GDP now, the Atlanta Fed's estimate was estimating negative 1.2. So this is the first time in a while that the GDP now has come in erroneously to the downside. GDP now has been off to the upside the last couple of quarters. So this was a little bit of a surprise to me. I was expecting a negative 2%. Mish nailed it. Mish called negative 1. So you were just just off a dead bullseye there,
Uh,
Mish. Pretty good call.
just a little outside.
Just a little bit. Also, we got some earnings came in
I,
last night. Facebook or Meta's earnings came in. Uh, they missed top and bottom line. Bad quarter. It was the first year-over-year revenue reduction, or first. Geez, I butchered that statement, didn't I? The first revenue decline ever year-over-year for Facebook. I'm not calling them Meta; it's a stupid name. We also got Ford. Ford posted really good numbers yesterday. Ford's margins are just exploding higher. They're weathering the chip storm pretty well. So Ford was looking good. And Qualcomm also posted pretty good earnings, but Qualcomm forecast a reduction in their handset sales, i.e., iPhone, smartphone chips. So the forecast for Qualcomm is what took that stock down despite posting a good quarter. And that's interesting because we've got Apple coming out later today, the biggest company on earth, and that's iPhones make or break Apple's numbers. Qualcomm just warned that they're expecting lower chip sales for smartphones, and here comes the biggest smartphone maker. So we may have a negative surprise coming from Apple later on today. Although with this market expects lousy numbers, and when we get lousy numbers, the market rallies on lousy numbers. So I'm it's going to be hard to say whether or not we actually move down on that news. And I just want to say thank
well,
you to Mr.
PCE
Contrarian. Oh
came
wait,
out also. Good.
let me thank Mr. Contrarian before we get into PCE. He says, "Do you think some of the strength in GDP has to do with the bifurcated nature of lockdowns? Here in Florida, population increased, housing still strong. New York, no." So will that's That's interesting. I love that word bifurcated, by the way. I crack up every time I use it. Um,
You really do like that word.
yeah, I do. I do. So the bifurcated nature of lockdowns, well, it's within the US. That could cause regional discrepancies in GDP, right? Like people are leaving the cities like crazy. So that's causing a decline in the cities, but that's being offset by a boom in areas like Phoenix, Scottsdale area where all the people from California are moving to, or like Jacksonville, Florida, Orlando area where all the New Yorkers are moving to, right? So it's causing a displacement, but I don't think there's going to be a net effect on GDP from that because losses in one area are made up for by gains in the other area. Um, let's see, the strength of GDP has to do with the nature of the lockdowns. Increased housing is still strong. So you're right, that is causing some home construction that that's causing, although we're still seeing a slowdown, the new housing starts, they're just not keeping up. It's causing problems in the housing market. Let me put it that way. It's driving up home prices, contrarian, because people are leaving New York and California and they're bringing their concept of what a house should cost with them to the cheaper markets, and they're bidding up the prices in those markets. And at the same time, the commercial real estate values in the cities, for whatever reason, however they're being artificially inflated or having their income statements adjusted, those real estate values in the cities haven't quite crashed yet. They should. They probably will. It just hasn't happened yet. So that, I guess, when I think about it in terms of housing and real estate, that could cause an increase in GDP. That demographic trend. That was, you really made me think with that comment. Thank you very much, Contrarian 08. Appreciate the super chat and support of the channel. All right, Mish, what do we got on PCE, sir?
So PCE came in flat. It was expected to come in at 6%. It came in at 7.1. Last month, it was 7.1. Or last quarter, I'm sorry, it's also a quarter number. Last quarter, 7.1. This quarter, it's 7.1. It was supposed to come down to 6. And core did come down, which is what we were talking about with the different commodity prices.
Yep.
In the last, 6 weeks or so.
What did core come in at?
4.4. In line with the expectations of 4.5.
So what Mish is talking about here, PCE, that is personal consumption expenditures. That is the Federal Reserve's preferred measure of inflation. The Fed tends to watch PCE more closely, whereas the public tends to watch CPI or Consumer Price Index more closely. There are subtle differences in the math. Why does the Fed prefer PCE? I don't know. Probably because it's lower and it makes them look good, look better. That's why they
right.
like PCE.
They try to sell it that this is what the consumer sees on a day-to-day basis, because it is the expenditure numbers. So that's one, it's lower, but two, it's more of what the average person sees. So that's kind of why.
And the average person sees a whole heck of a lot more than 7.1% cost of living increase. We all know that. We all know these numbers are BS. And I've talked about it on this channel a lot, that the government is incentivized to understate inflation because inflation gives them a raise. And then if they understate inflation through their various metrics, they don't have to give you as big a raise in your Social Security payments or in your pensions or in food stamps or any number of the government programs that are keyed to inflation. So their income, the government's income, keeps going up because inflation does tend to drive wages up a little bit at least, and it drives up asset prices and capital gains taxes. The problem is the government collects all that money and then they pay out less because they understate inflation. In other words, you get poor, the ruling class gets richer because tax dollars are just this big pool of money to be embezzled by powerful people. Now, when Mish says core PCE, what he's talking about is when they take out, using their words, they strip out volatile food and energy. All right. Which, who needs food and energy to live, right? It's not like you need gas in your car to get to work or food.
Who needs food, right?
It's nuance. So they'll take out the food and energy, which they deem is too volatile to really count. And then they tell you what everything else does. So core PCE, they're saying, is up 4.4%, which means most of the gains in inflation are still being driven by commodities, by food and energy prices. Right. Now, we're seeing declines in food and energy prices, at least relative to the ridiculous highs that we saw in March. But something I've warned about in this channel before, that is being almost entirely driven by the dumping of oil from the Strategic Petroleum Reserve. The government has these giant underground salt caverns full of oil called the Strategic Petroleum Reserve. And we are taking that oil is set aside to power our military during times of war because we saw how the German military machine was just ground to a halt in World War II when they ran out of oil. And so we set aside this massive oil stockpile to make sure that never happens to our military in a time of war. Well, right now we're using that emergency oil stockpile. We're dumping it on the open market to keep prices artificially low. Some might say to prop up somebody's poll numbers. I just throw them out there. And that is 1 million barrels of oil a day, which is the equivalent of all the oil output of like 3/4 of the OPEC countries. And we're just dumping it on the open market. So much of it that our refineries can't even process it into gasoline. So they're exporting it to other countries. So we're subsidizing cheap oil for the rest of the world right now by dumping our military's fuel stockpile. Well, that's driving down oil. That's driving down food. That's driving down everything because just about every other commodity is in some way a derivative of energy prices. So that's artificially skewing the inflation problem lower. Now, here's the thing. We're going to run out of oil in that stockpile. If we continue at this pace, we're going to run out in a couple of months. So what they're doing, as soon as the midterms are over, as soon as the elections are behind us, they're going to stop dumping that oil from the SPR. And that energy inflation is going to come rip roaring back like you wouldn't believe. So when you see core PCE going down and when you see these government bureaucrats taking a victory lap in September, patting themselves on the back and congratulating themselves for doing such a good job fighting inflation, just know by the end of the fall, by the winter, it's going to be even worse. That's just my take. That's what I see happening in markets. Others may disagree. That is unless they just crash markets. If they totally just crash markets, then we have a whole different set of problems, deflation, everything else. Anyways, guys, we are fast approaching 45 minutes. I think we're probably going to wrap it up here pretty soon. Again, the GDP number came in negative 0.9% for the year or for the quarter. So that is meeting the technical definition of a recession, 2 consecutive quarters of negative economic growth. So the press and all the talking heads are going to circle the wagons around the Biden administration and deny that it's a recession. Look, math is math, numbers are numbers. We're in one, folks. We're in a recession. The economy is shrinking, and inflation is a big input to that. So that's just my 2 cents, folks. You take that and you do with it what you want. Mish, you got anything you want to add?
Everybody, remember to spay and neuter your pets.
We're working on that send off, Mish. All right, folks. Thank you, everybody, for your super chats, for your support of the channel. Please like this video, subscribe to my channel, and also special shout out to my Patreon supporters. Thank you guys for everything you do to support the channel. There is a link down below should you feel so inclined. And until next time, live small and dream big.